Okay, hello everyone. Good evening, morning, or afternoon from wherever in the world, which part of the world you are joining from. It's Muhammad Ishan Dakhi with you from Hub of Finance Transformation. So, first of all, we warmly welcome you to this exciting webinar series of Webinar Series 2023. And today is the third episode of our series that is on merger and acquisition in times of disruption and transformation. So this is really a very, I think, hot and really important topic these days, given the uncertainties and the macroeconomic factors and the VUCA environment that we are looking for. So as you all know, the deal makers are really more conscious about these macroeconomic factors and all the uncertainties and the global uncertainties, disruption, technological disruptions that is going on. So that's what all our experts who have joined us already from Egypt, Mr. Ahmed Ashkar, who is the ex-senior partner of transaction services in KPMG Middle East. And we have Ahmed Ghazi as well, who is corporate finance M&A expert, and he is also having a rich corporate experience from Big Four
Yes.
consulting firm, as well as serving as the FP&A head in the
Yes. Hi.
group of companies in Saudi
I'm good.
Arabia.
Thank you.
So, just I would request all of you to please mute yourself, and so that there will be no disruptions during the call, as we want to make it interactive. So we are keeping you on mute. And so this is going to be a 1 hour webinar, and we will be having two presentations. We will start with Ahmed Ghazi, who will share with us some foundations of merger acquisition, what it is, the entire process, the flow, the journey of M&A, and also some of the foundation concepts that we will build upon the upcoming slides that will be shared by Sir Ahmed Al-Ashkar, who will be talking more on the M&A in times of these disruptions and what are the factors to consider. And he will be sharing his own insights and his rich corporate experience in this area of transaction services with the KPMG and multiple clients, IPOs, merger acquisition deal that he have carried out during his tenure. So that's what we are going to have this presentation for around 40 minutes, and then we will have 15 minutes for the Q&A session. So if you have any question during the webinar, just feel free to drop your question in the chat box, and we will try to answer as maximum questions as we can. Otherwise, we will take it offline as well to get your questions answered later on. So without any further ado, I would like to invite, first of all, thank you very much, Ahmed Ghazi and Ahmed Ashkar, for joining us this evening.
Good evening, Muhammad Zishan. In the beginning, I'd like to thank you too much and Ahmed Al-Ashar for the kind words and the introduction.
Thank you.
Now, just to scratch the talking, during these times, the talks and the topics, hot topics now becomes more available than before about the M&A transactions and the financing solutions of the company, as long as the M&A has used to be one of the top hot agenda of CFOs and the C-level of companies. Over the past 3 decades, we noticed that the transaction of M&A get to its peak. However, my expectation is not to its peak yet, and more to come, specifically during the disruption times and difficult times. M&A transactions plays a vital and pivotal role into the economic. Before we speak about the details of the M&A transactions, very important to know why to go with an M&A transaction. To answer this question, you have to put yourself into shoes for both the seller and the acquirer of the company. Both sides have a common interest into this. When I offer my company for a sale, or when I seeking to have an investment in another company, definitely we have a different justification for this. From the point of view of the seller, maybe I'm someone who my company has reached to its maturity level. I received the investment that I usually I planned before I got into the investment. I returned the required investment, and this is the time to exit from my business. This could be one, and maybe another one, a person who is still on the contrast in the growth stage and looks forward to raise fund and to take his company to the next level and scale up his business and need some kind of financing, and he still need to be into private sector and looking forward to raise fund from an investor, whether it's controlling or not controlling. And another reason or objective could be restructuring for growth. And this has become popular during these days when the companies try to find a new model, restructure its business model to reach to the its maximum utilization of the investment and available assets. So this is usually from the side of the seller. From the side of the buyer, I think it's much more wider and much of justification behind this. However, we can subdivide both into two key things. One is strategic acquirer, and second is the financial acquirer. The strategic acquirer actually is the one who works in the same industry and looks forward to consolidate and get and try to make some kind of market entry barrier to other competitors. As you know, within the Porter 5 quarter analysis, that big companies try to acquire each small company to make it very hard to other companies to penetrate and take the market share. So this could be one of the main reasons, is to acquire new technology and establish a new market barrier entry to anyone who looks forward to join there. One more thing is the market consolidation of similar industries. Now, this appears apparently and obviously under the FMCG and retailer. We have P&G, we have Unilever, and similar companies that are consolidating and acquiring another companies into the retail market and FMCG market to utilize from the synergies the other companies has, and the synergies will arise from the combination of the two companies together, alongside with the cross sales and other distribution channels, maybe for entering a new market as well. Third one could be catalyzing for value creation drivers. You know that any business aims at end of the business, end of the day, it looks to maximize shareholder return and create value to the shareholders. Maybe for an existing company, it reached to its peak and no much growth opportunities are available there, that through organic growth, and companies may look forward to acquire another company to have a potential and a leverage on the other companies technology and whatever they have into the market. Some transactions maybe come from the tax and financial exemptions. Now, a company or a target company into a foreign country, they may offer me some incentives to enter to the investment by offering me a tax exemption for 5, 7, 10 years, so on. So this could help me much and catalyzing me to get into any transaction into this country. It may be only financial or tax exemption purposes, or could be for value creation, or it could be more strategic through acquisition of a competitor, or one of front-end integration, back integration into my industry. So actually, these are the main key drivers for any M&A transaction. It could be tons and hundreds of reasons behind this. However, we can categorize, or let's say categorize all these reasons under this main factor. Now, this is how we start the M&A transaction. The process of the M&A transaction itself seems to be very long, and sometimes could be very complex, depends about the transaction itself. But for guaranteed, it has to start with the deal strategy and adopting the strategy. And under the deal strategy, you cannot go and say, I will acquire this company, because no, the strategy starts by adopting the whether you are look forward to go through organic or inorganic. This decision takes much of studies in-house, and maybe you can get assessed by another consultant from other firm or expert and so on. Once you start by adopting the strategy that you are looking forward to grow through acquisition, then you should start putting yourself into the mode of the acquisition. Generally, we can say that the M&A transaction may be categorized under three phases. One is planning, second execution, and third could be completion in itself. And under each of these phases, we have a sub-phases of them. Under the planning, which I see this is becomes as a very important part of the transaction, is assessing the deal strategy, whether you should adopt this strategy to acquire another company or not. Under this stage, you start by articulating your strategy, assessing the market in itself and the visibility of another company, whether you have to take a decision of acquire or build or lease. Under this stage, much of detailed market research, financial models, assisting with all stakeholders, people, get the feedback from different stakeholders around the strategy to make sure that you are adopting the right strategy and you are not wasting the resources of the company that you have. During this stage, we can say that the CFO has an ultimate involvement into the transaction by providing project management into this through inputting it with the shareholders the required information needed, whether it's from market research or industry and financial in itself. Once we agreed with the investment strategy of us, which is an M&A, we decided to do M&A. We start to put this strategy into an action, more actionable insights through making an initial screening, list down what kind of the investment we are seeking to have, what is the characteristics of the business, what are the key financial metrics is, and we start listed down more narrow and more detailed and trying to make it more actionable to proceed with. During this time, the CFO, usually we call it the screening, initial screening or sourcing the deal. You might have a good connection with investment banking, private equity, some of your relatives, and maybe through internet. There is much resources where you can reach out with the target companies. You start make something that we call qualification. You qualify the companies that you have. You have a list of targets around 100 companies. You qualify them to only a manageable number of transactions or manageable number of targets that you start to communicate with. Once you agree with a specific 1, 2, 3 transaction, you start to go much deeper and start communication here with the target company, XYZ company. We start approaching to their management, showing your interest that you are looking forward to acquire their company. You engaged an initial talking with them. This is which we call the preliminary due diligence. Under the preliminary due diligence, you start communicating with the target company, and during this time we sign the NDA. As long as we start to have an access to the information, even if it's not this kind of detailed information, but once we start communicating with them, we have to sign the NDA, and we start looking for their key information provided by the management. Under this stage, we start preparing the desktop valuation, which is the range of overall valuation without going into details, and assessing to comply with our deal strategy that we adopted in the first. And we start to send them the request for information and notify them about the data room or virtual data room kind of information that we are looking forward to have a look by assessing by our consultant later on. In this stage, the involvement of the CFO becomes much more deeper, much more critical into this stage, where this, yeah. Okay. During this, sorry.
I think there is some ego in your voice, Ahmed. It's returning back.
Okay. During this stage, the CFO becomes the major and dictatorial player of the company, because he's the one who will contribute the valuation and the financial information provided by the client. Once we are fine with preliminary due diligence, now we will start going into deeper the virtual data room, have access to books of the company, and now we are more serious about acquiring the company. We sign letter of intention, which consider a non-binding offer. We're telling the company we are interested in acquiring your company with this range of valuation, with this kind of terms. Please let us have an access to your room and go much more into the your books. Once we go into their books, this is due diligence process, which Ahmed Al-Ashar is the expert into this process. He had hundreds of transaction experience in the Middle East. He will give us more insights more than me. Now we have the concrete background on the deal itself. We know that we have a target company. We know its valuation. We have performed the related due diligence and come up with some of adjustment. Due diligence provided me with the red flags of the risks that the transaction could carry and for the potential synergies that we might have. Once we reach to this stage, we have to set with the target company to articulate the sales purchase agreement, and we will say that this is the time. Yes, Ahmed, we can see you. Nice looking. And this is the time that we need to finish the deal, we need to consolidate the company, and we draft the sales purchase agreement stating all terms, and all stakeholders get involved into this, and more probable into the with the legal advisor, because he's the one who's drafting this document. Under this stage, we start by, from our side as the acquired company, to fund the structure. This initially have been adopted during the deal strategy assessment. This is part of the deal strategy, whether we're going to acquire the company through debt, through equity, or mix of them, what is the percentage, the capital structure that maximizes my profit, which we started from there. During this stage, the CFO as will play the vital and dictator role here, because he's the one who has the in and out of the finance. Once we agreed with the deal, we financed it, we performed the due diligence, become in and out, and financed already the deal. This is the time to close the transaction, start the preparation for constellation, and later we can call it the post-merge acquisition, which take us for a longer process stage. Usually the time it consumed for any M&A transaction, since we agree on the strategy until the completion of the transaction, it may be a few months, maybe up to 1 year, depends upon the complexity of the transaction and how the both parts are agreed on and based on how it goes. This is generally the process that you usually have. It could be more detailed, it could be more easier. It depends about the company itself and transaction. Now, we should consider much about the risks that are threatening to the transaction itself. Much of the threats could come to the transaction from all sides, whether it's legal, environmental, and restriction of the government and regulation in itself. However, we can say that we have main or key three precursors of any deals or risks to deal failure. One is overpaying to the transaction itself. At the end of the day, we are investors. We are seeking to maximize our profit and maximize our return on shareholders' value. So we need to make sure that we are paying exactly what this company equal or valid. I don't want to waste my money and pay overly in this company. Actually, the excess, which we call it excess purchase price, could come from different sources. Maybe because we have an optimistic assumption about the valuation itself, or the seller requests a high premium to acquire his company, and maybe you are, as an acquirer, assumed unrealistic and very optimistic synergies during the transaction. So it is very important to consider, and here is the importance of the due diligence in itself, where the due diligence report will provide you an overview and about the assumption that you assumed in the deal strategy and the finding that they have, and whether you have to take your consideration in, or this is a red flag, this is an opportunity you have to consider, or you have to leave, and it is the time to walk away from the transaction, or it's still profitable for your side. That's number one. Number two, for the post-merge integration, much of transaction, let's say the majority of transactions failed due to the unplanned integration after the acquisition itself. Why? Because people usually, or the people working on the transaction, don't pay attention too much for the culture cultural environment, and other considerations. It's very important to consider the accounting implication, the tax implication, the legal implication, the human resources, all these things. At the end of the day, the company, you are buying the management, you are not buying an asset. So acquiring management requires from your side to assess the visibility and make a risk assessment for each part of the organization, starting from the financial, commercial, HR, and legal side, and to ensure that once you acquire the company, you are owning the capabilities, calibers, and the resources to make sure this company properly integrated with your business. And third one is, let's say, failure to realize the synergies that you adopted into the strategy. As you mentioned earlier, that any company specifically into as a strategic acquirer acquire the company due to the synergies that could arise, whether it's financial, revenue, or cost, or whatever. So before going into and completing any transaction, you should be sure about that you have the tools to realize this assumption or synergies that you assumed at beginning of the transaction. As losing the ability to generate and realize the synergies is in its own sufficient, that makes you to lose the value of the company, and could trigger for the other two reasons, which is post-merger integration difficulties and overpaying for the price. So let's say these are the key items for why the transaction failed. And we are looking forward to have with us soon into the CFO program, where we are covering the whole process into details from the point of view of acquirer and seller, and a CFO as well, with practical life cases and practical previous transaction. So that's from my side. I'd like to hear back from you guys. Ahmed, please. I'm sorry if I take your time. Thanks, Dishan.
Thank you very much, Ahmed. I think you shared a really great insights on the drivers of M&A, the entire process of M&A, and the three key reasons. So I think this is really a great insights and a great start to have our next session now with Ahmed Ashkar. Ahmed, over to you now. Ahmed, you are on mute. If you can unmute yourself, so we can't hear you.
Yes, you can hear me by now.
Yeah.
Yes, okay. Thanks, Zishan, for having me on board, and thanks for Ahmed Ghazi for the good preamble and how is the M&A full process would be summing up. And I believe that we have a very tough and hard time by now. And let's start with, the global macroeconomics and cascade down to our local markets and how this would impact the M&A transactions. So I believe in the introduction, we do have two major challenges that happened in about 3 years, which is very lots on our plates. And you cannot show all those challenges, which is the pandemic into 2020. And until not the world would be recovering from the pandemic, we do have the Russian-Ukrainian crisis. And both had been having very negative downsides on the M&A, and we just need to align and to focus on what would be the obstacles that would have or shed some red lights on the M&A and how we can tackle it. So I'll be starting with the emerging markets. Okay, so in general, we do have a manifest today that we will be summing in the next 18 minutes or something like that. So I'm trying to focus on what would be the macroeconomics of the world by now reflecting into the emerging markets. And The reason that I've chosen the emerging markets because this is the least developed market economically, and this is the markets that I'm very excessive working in, which is the Middle East, the GCC, and part of other markets as well. But mainly we would be into the Egyptian market and the GCC as well. We will be having the effects of the fair value measurements on the M&A. We will having some lights on the WACC, weighted average cost of capital, and finally some we cannot underpin the language that the financial statements are written in, which is the IFRS, and what are the problems that reflected on the IFRS as well. So we'll be starting with the emerging markets. So if we do for an instant having like Egypt or the Middle East in general, I'm talking about not Egypt only, I'm talking about Egypt, Jordan, Iraq, Syria. The GCC is another market because it's more let's say liquid and more wealthy. So if we took the emerging markets and like Egypt after the war, 3 to 4 weeks, we do have like $22 billion US dollars, and it is dollars rather than Egyptian pounds. So we do have 22 billion US dollars have been migrated all of the sudden from the market. Which is known as the hot money had been buzzed off, and a very massive kind of sale of stocks, treasury bills, shares from the market, leaving the market back in a very massive chaos. So this is why, because on the time of peace is a golden rule that the investors like the riskier assets, because as much as the asset is risky, as much as the returns. While on the war, you will find that riskier assets are not favorable anymore. So all the investments or foreign vehicles would be buzzing off the market, flowing into other developed markets. So this time it's logically to go to the Latin America, like Brazil, like Argentina, but this is why it had been flying to the United States, and this is very obvious because the US federal had been using like a very tight monetary policy for the last year and the early of this year as well. It had been skyrocketing the interest on the US dollars until it reached 4.5 basis points. So those three items had been combined together, that leaving the emerging markets in a very messy situation. And next, please. So this shed some bad lights on the investments and how it would be measured. So number 2 of the aspects that we need to look, which is the fair value measurement. So the IFRS and as well that the valuation standards give 3 general methods of valuating your investments. And I know that pretty much that you have a good knowledge on those, but I'm trying to see what would be the effect of the fair value measurement in this disrupted world on the 3 valuations. So you will find that the market approach, which is using the prices from listed companies or from closed transactions, you will find that to give you an instant or a flavor. So the multiple here in Egypt used in 2019, just before the pandemic, was about 8 to 10 multiple or 8 to 10 times of the enterprise value, the EV. After the pandemic and approaching the war, or the Ukrainian-Russian war, you will find that it had been diminished to only to 6.5 times the enterprise value. So this is a very massive haircut to the fair value of the enterprise value of the companies. Number 2 is the cost approach, which is using the replacement cost. And the problem of using the replacement cost, that it is due to the lockdown into the pandemic, like China has been locking down many counties over there, United States, Europe as well, and the Ukrainian-Russian war as well. This made that the magnitude of the commodities that is or the supply of the commodities had been diminished a lot due to the lockdown and ceasing manufacturing. And number two is the unsafe sailing of the commodities around the globe due to the war zone. So you will find that the replacement cost is skyrocketing, and the prices of replacing a machinery, replacing a certain kind of equipment, vehicles, is skyrocketing as well. Number three, the income approach, and this is our favorable one, which is the DCF. We love it so much. So the discounted cash flow, you will find that the items that's the DCF is based on, like the revenues, the income statements, balance sheets, and all that stuff, is very volatile, and there is a massive uncertainty about the revenues and the valuation of those revenues as well. Next slide, please. So second one in a row, which have been affected and is still here in the emerging market, between brackets, Egypt. You will find that the WACC, two components of the WACC, very in very general speaking, the equity component and the debt component. So when the interest have been skyrocketing into the made by the U.S. federal, so all the emerging markets have been increasing massively the interest rates as well. So it's unprecedented. We find that deposits with 22% and 25%, and in the first of next March you will find, or sorry, in 30 of this March you will find maybe 30%, which is interest on deposits and certificates. So the cost of fund have been skyrocketing, and add on this, the bank would be adding like 2% overheads, 3% profitability. So the cost of debt would be more than 30%, which is a very, very high component of the WACC. And if you find another thing as well, the equity component of the WACC, or using the risk-free rate. So generally using the long-term bonds, or this is not very popular here in Egypt. So the evaluators or modelers are using the treasury bills, which is more popular and more into the market. Now it's about 22% and interest. So that the government is trying to attract who is said to be the interest traders. So it's competing, it's very hilarious. That's to compete with the United States market and increase the interest on the Egyptian pound via the treasury bills. And we do have a dollar component as well of the treasury bills, which is 4.9. This meaning that the WACC calculation through the either the debt component or the equity component is skyrocketing. If you do have to add on the WACC a premium for the political instability, for economical instability, bad macroeconomics, you will be giving like a WACC which is very, very big in size and discounting the revenues of the net cash flows of the companies, giving into a very smaller enterprise values. The third one. This is, something which have been, let's say, neglected, the valuation discounts. And many modelers and valuators, I see that they are neglecting the valuation discounts, which is very important. We do too have two kinds of valuation discounts, if you can, yes, the control and the marketability. So the control discount, or the discount for lack of control, DLOC, which is, if you are acquiring minority, and this is less of an important for me over here. So you get into the enterprise value and then apply the discount for control. It give you like a minority, but unmarketable, and then discount for lack of marketability. So if I am valuing a company which is not listed into any stock exchange, so I am applying a discount so that the enterprise value will be discounted by 30 or 25% for the lack of marketability. But I believe that the DLOC of discount of lack of marketability, DLOM, I'm sorry, discount of lack of marketability would go for further step and be applied on the companies that are even listed but into illiquid markets. So in the position that we have in Egypt over here and the fleeing of the 22 billion US dollars, so the markets have been left illiquid. So I believe rigidly that those kind of companies, even if listed, should be applying some of DLOM as well. This is, very rapidly, we did have like the macroeconomics of the global, what's the obstacle, how it shed some lights over the emerging markets, over the three methods of valuation, over the WACC, over the discounts. And finally, we cannot, neglect the IFRS and its a reflection on the M&A. I just, get like a handful of positions or let's say controversial points, which are affecting, the IFRS presentation and valuation as well. So the IFRS is very widely spreading by now. 144 countries is doing IFRS. United States, they don't want to lose the leverage, but anyways, they are trying or have a certain project to go from the US GAAP into the IFRS. So I believe we do having a world of IFRSs by now. So number one, we do have a major problem of the IFRS 15, which is the revenue from contracts and customers, and how it is very controversial in respect to the performance obligation, because the standard have been changed from the usually known as transfer of risk and rewards into the performance obligation. So the client would not be paid until there's a certain performance obligation that have been fulfilled in total or by time or in a bullet. So this is very important as well. Leases, which is the typical problem between the operating lease and the capital lease or the finance lease. And I believe I can recall that in all due diligence that I have did for the last 22 years at KPMG and old MESA, Middle East, South Asia, we will always make a very big adjustment for getting, the operating lease into a finance lease, because, this boosted the EBITDA of the companies very massively. Number three, the impairment and the problems reside with that. You need to gauge the indicators of the impairment and catch it every reporting period. And number four, the goodwill and the intangible assets, they are very vulnerable and subject to impairments as well. I believe this is all for today. Open for questions by now. Thank you.
Yeah, thank you very much, Ahmed, for sharing the great insights and some latest developments in the area of M&A and from the global perspective. So there is one question, I believe, Ahmed Ashkar, it's addressed to you. As you mentioned, I think the three approaches to evaluate the M&A deal, like income approach, evaluation, market approach. So which approach is the most suitable to evaluate the startups? There is one question from our audience.
Yes, okay. This is a very tricky question, and thanks, Zishan, for that. Anyways, usually for example, the DCF wouldn't. This is very popular here in the market, and in every market that I worked in. I worked in MESA and UK for some, IPOs as well. So the DCF is usually the easiest one. But the problem is that the startup wouldn't be having like the full history that you can analyze and built on in order to make 5 years or 3 to 5 years for. As well, the startups wouldn't be like, let's say, a very massive assets, so you can make like an evaluation on asset approach. So I believe the best way to do it is the multiples, even the multiples of the listed companies or the multiples of the closed transactions, and you will find some very valuable information for this side of the world in the blog, the famous blog of sorry, I missed the name.
Darmudhan.
Darmudhan. Yes, right. If I answer your question, yes.
Okay, very clear. And the next question is, as you mentioned about US interest rates. So how do you see the impact of this on the M&A going forward, and also the impact of these on M&A deal regionally as well, if we talk about?
Yeah, I believe this is very interesting because I never been a pessimistic, and I don't want to see that all those rates, inflations, and all that stuff would have like black shadows on the M&A. No, for example, the increase in the or the tight policy of the U.S. Federal would urge the emerging markets to increase the interest rates, and this would in order to curb the inflation. So you will find that, and all the sovereign funds of the GCC, I mean United Arab Emirates, Saudi, the Qatar. So they are all working on the companies in Egypt. That's why, because those increases in interest rates led to 3 devaluations into that led to 50% of the Egyptian pounds to be devaluated. So this means that the company are more appealing, more sexy enough to purchase in US dollars, because the Egyptian pounds is devaluated. So this is very optimistic for investors, while for Egyptians, maybe they are struggling with the higher prices and all that stuff.
Okay, and I think in continuation to this, we have one more question from Mohammed, that will Saudi sovereign fund and the Egyptian central bank will find a middle ground for the fair value of Union Bank?
Yes, thank you. We are following. So this is a very popular question, and I believe they will find the ground. And the attempt of the Saudi sovereign fund is just to give a message to the Egyptian government that you need to make a fourth devaluation of the Egyptian pounds. And this have been read as well in the latest report that have been published by the famous French investment bank, which is Société Générale, that the Egyptian pounds need another devaluation, which is the fourth one within a year in a row. And this is a message from all foreign investors. I believe they will be having a ground of interest very near.
Okay, that's great. And there is one question for Ahmed Ghazi as well regarding his part. So Ahmed, as you described the complete flow and the process of M&A, so which part of the transaction seems to be the more critical for the deal success, if you can highlight? Ahmed Ghazi.
Thanks, Ahmed Ashkar, for your time, insights, and thanks, Zishan, for the question. I think looking back to the M&A transaction as a whole, we cannot say that we have a most critical one amongst them. We can say which one that takes the much of the time or consumes much of the time, as each part of the transaction contributes to the shareholder value at the end of the day. But I think most important part, if in my point of view, or which is more critical for the transaction, is the investment strategy in itself. As long as you will not benefit from a car, for example, if you are driving a car full of oil and it's a good car, you know how to drive it, but you are driving in a wrong way, this oil and good car wouldn't help you because you are in a wrong way. So knowing exactly where you are putting your legs, what is your strategy, what you expect to come, proper planning and the proper assessing the investment strategy, I think this is the most critical part in the transaction. The other phases of the transaction coming from selection, training, valuation, and so on, you can, at the end of the day, you can manage. You can agree or disagree. You can walk away from the transaction. You can exit from the transaction anytime. If you find yourself is not beneficial from the company, you can exit from the deal in itself. But I think the most critical one, as you mentioned, is the deal strategy in itself, assessing and setting up what is the deal breakers, what are the items that will make you say, no, I will walk away from the transaction, and what actually go into the transaction, and what to find into the transaction itself. Yeah, I hope I answered the question.
Yeah, I think it's very clear. And another question is about the new era of venture capital and startup. Do you think it will shape a threat to the traditional M&A work?
Yeah. There is much of confusion and misunderstanding around the venture capital and the startups. This era going to replace the traditional merger and acquisition transaction and so on. Indeed, there is no any confusion and there is no conflict between of them. The whole matter is the change in the way of the companies used to work. Now, the same process when you are working in a VC to acquire a company or to sell a company, you will follow the same step, the same concept. With the same, you will perform a due diligence, you will have evaluation. However, the only change would be into the some technicalities and details. For a startup company or a VC, when you are acting like a VC acquiring a startup company, you will look into the due diligence, more into the technology, more into the commercial side, the customer acquisition, and the sizable market, and not into the financial as we used into the mature company. As that makes a lot of sense since the company is a startup and no history. No sufficient history where you can build up your estimate on. So only in details you will have some difference, but into the process in itself, it's the same. As well on the level of communication and the target markets. The traditional M&A transaction usually happen across all transactions industry, whether it's manufacturing, FMCG, aviation, startups, whatever. But under the startup and VC, they focus only into specific narrow sectors like fintech, technology, SaaS, and which stands for software as a services, and PaaS, which is banking as a service, consumer finance. It's somehow narrow. But for the steps in itself, for the process and flow of the work, it's the same. And as well, one part is the valuation consideration under the traditional business, as Ahmed just mentioned. We have a discount cash flow, we have trading comparable and present transaction. In the startup, the situation is somehow different. For a company, it's still starting. It's a pre-revenue, and after revenue, we have seed, pre-seed, Series A, B, and so on until we got for the exit or the IPO. So it's all the technicalities difference into the evaluation and into the due diligence, what exactly we look at and how we assess the investment. But for the process in itself, if it's a pure M&A, it's still the same with some minor changes. Yeah.
Okay, I think that's very clear. I think you identify the difference. Thank you very much, Ahmed. If there is no more questions, so we can just give you a first overview, those who are joining us for the first time. So Hub of Finance Transformation is basically, we are a academy and a consulting firm. We are also the authorized training provider of AFP. We are the training partner of PwC Academy Middle East as well. We are also the part of AFP FPN Advisory Council. So far, we have trained almost more than 3,000 accounting professionals, accounting and finance professionals across more than 25 countries through our online and on-site workshops and training program. Also, we have on the consulting side, we have different verticals, as you can see: finance transformation, FP&A, digital technology advisory, and M&A that is being taken care by Ahmed Ghazi and Ahmed Ashkar. They are our partners in the M&A and transaction advisory services. So that also what we are providing. And some of our clients that we have served during the last 4 to 5 years of our experience. And this is a very interesting program where all of these topics of merger acquisition, we have encapsulated different areas into this program that is called the Next Generation CFO Leadership Program. We have already completed the first batch where almost 17 participants joined us from almost more than 12 countries, and they have already completed their program on the first batch. Now the registrations are open for the second batch that is starting from 29th of April. So here, as you can see, we have 4 modules and the elective modules. Elective modules mostly will be covered by our today's speaker, Ahmed Ashkar and Ahmed Ghazi, who are experts in this area of fundraising, IPO, due diligence. So either you can take the full program as a package, or you can even take these electives as an individual as well, like due diligence or IPO readiness or project financing or corporate restructuring. So this is a very comprehensive program that is around 7-month program, and it's fully virtual. And it's starting from 29th of April, where Ahmed Ghazi and Ahmed Ashkar are our key instructors for the elective courses under this program. And we have many more instructors from UK, from US, from Canada as well. who will be delivering the second batch of our next generation CFO leadership program. So if you are interested in learning more deep dive with the case studies, more practical tools, if you are pursuing your career in the M&A, or you are trying to make a transition into the role of M&A, I think this is the best opportunity for you to learn from practitioners like the ex-senior partner of KPMG, Mr. Ahmed Ashkar, and also Ahmed Ghazi, who worked for a big four consulting firm on the transaction advisory side. And they're all going to share very practical experience. This is a very practical program. This is designed for the CFOs and the C-suite level professionals. So it's not at all the theoretical topic. It's a very practical program that based on simulations, case studies, and real life case examples as well. So that's all about us, our programs, our consulting services, as you can see, and our team members are here also, Ahmed Ashkar, Ahmed Ghazi. Thank you very much for sharing your great insights this evening. And many people are asking, I think, about the presentation and the recording. Yes, we will be sharing it, the recording. It will be also available on our YouTube channel, and you will get it all on your registered email ID as well by tomorrow. It will be sent to you all. You can share, you can access the recording as well. So that's all from our side. If we have last 2 or 3 minutes, if any more questions, please feel free to ask your questions or drop in the chat box. I can see some questions. Okay, fine, thank you. Okay. We are also live social media. I think we took the questions from there. Thank you so much, Ahmed. Okay, thank you. You're welcome for joining. Okay, thank you all. Thank you very much. I think everyone, it looks like everyone enjoyed our session. Thank you for your feedback. And really, we are looking forward to more sessions with the M&A and the deal advisory experts, transaction advisory experts in our coming months as well. Thank you very much, Ahmed Ashkar, Ahmed Ghazi. Special thanks for sharing your.
Thanks, Zishan. Thanks, guys. Thanks, Ashkar. Thanks for attendees today.
Okay, thank you, and have a good night, everyone.